Ever pondered what makes the world's top investors so successful? Well, there's more to it than just numbers and graphs. It's about their diverse approaches, their rich knowledge, and the countless years they've spent delving into the depths of the financial markets. Drawing from their vast experiences, these giants of investing have crafted strategies that set them apart and have sustained their success over the years. First, let's delve into the mind of Benjamin Graham, often hailed as the father of value investing. Graham was a staunch advocate of critical thinking and independent judgment in investing. He believed that an investor's success was not just about following the market trend, but about having the ability to stand apart from the crowd. He firmly believed in the contrarian approach, buying when everyone else is selling and holding until everyone else starts buying, a theory that went against the grain of common consensus. This strategy, while seemingly simple, requires a great deal of courage and confidence. It's about going against the popular sentiment, about not being swayed by market hysteria. It's about having the mental toughness to hold on to your convictions and the patience to wait for the market to recognize the true value of an investment. The essence of Graham's contrarian strategy is not just about mere buying and selling, but about understanding market psychology and exploiting its inefficiencies. You see, this is the key to their success. It's about having the courage to go against the popular sentiment and the patience to wait for the market to recognize the true value of an investment. Next up, we have Warren Buffett. He is not just an investor. He is a disciple of the world-renowned Benjamin Graham. Buffett, known for his affinity for value investing, is a stalwart advocate for the importance of a long-term perspective in the world of high-stakes investing. He echoes Graham's principles of not just buying stocks, but understanding the businesses behind them. Believing in the power of patience, Buffett often emphasizes the critical role it plays in successful investing. He underscores that investment is not a get-rich-quick scheme, but an intricate game of patience and strategic decision-making. His investment philosophy, one built on in-depth analysis, studying a company's operational performance, its competitive position in the industry, its financial health, and above all, its intrinsic value. Intrinsic value, a concept Buffett often elaborates on, is the actual value of a company, taking into account tangible and intangible factors, as opposed to its current market price. Understanding this is paramount for investors, according to Buffett, as it forms the cornerstone of investing and helps discern undervalued stocks. Buffett's philosophy is encapsulated in his famous statement, "The stock market is a device for transferring money from the impatient to the patient." This simple yet profound axiom underscores his belief in patience as a virtue in investing. So, the key here is patience and a deep understanding of the company you're investing in. Moving on to Ray Dalio, who underscores the value of effective risk management and diversified investment strategies. Dalio, an acclaimed hedge fund manager and the founder of Bridgewater Associates, the world's largest hedge fund, is renowned for his distinctive views on investing and the economy. He preaches a unique philosophy that dives deep into the heart of financial markets. Dalio emphasizes that no single strategy guarantees perpetual success. He observes that the financial world is dynamic, with the market's whims constantly shifting and changing. Therefore, a strategy that has performed well in the recent past isn't immune to future failures. Dalio warns against getting swayed by recent trends. Past performance, he argues, is no guarantee of future success. He warns investors not to fall into the trap of believing in historical trends without questioning their future viability. Dalio cautions that the worst thing an investor can do is to have blind faith in a strategy just because it has worked in the past. Therefore, Dalio's advice revolves around the importance of managing risks wisely. He believes in not putting all the eggs in one basket, or in other words, practicing diversification. Diversification, in his view, about increasing the number of investments. Rather, it's about reducing the risk without sacrificing potential returns. He advocates for a balanced and diversified portfolio, where the risk is spread out among a variety of different investment types. This, Dalio believes, is the key to long-term financial success and stability. He urges investors to broaden their horizons and embrace a wide range of assets, thus creating a safety net against the unpredictable nature of the market. He advises not to have blind faith in past trends and to manage risks wisely through diversification. Peter Lynch, a name that commands respect in the field of investment, is often hailed as one of the most successful mutual fund managers to have ever graced Wall Street. Known for his remarkable consistency and prowess, he has left an indelible mark on the world of finance with his astute investment strategies and decisions. What is truly noteworthy is his approach to investing, which is both sensible and accessible. He fervently advises individuals to invest in what they know, in what is familiar and understood. He articulates that this method of investing allows one to leverage their understanding and knowledge, turning it into a potent tool for financial growth. Lynch's philosophy centers around the idea that investment opportunities are not just confined to the stock market or complex financial instruments. Instead, he emphasizes that they frequently appear in our everyday interactions, experiences, and observations. He urges us to observe our surroundings, to scrutinize the products and services that we frequently engage with, and to identify those that have potential for growth. He suggests that there is a wealth of information and potential right before our eyes, in our routines and habits. It's the coffee shop around the corner that always seems to be bustling, the mobile app that has become an indispensable part of our lives, or the retail store that continually outperforms its competitors. Lynch's investment advice is simple, yet profound. He firmly believes that by focusing on what we know and understand, we could uncover a treasure trove of investment opportunities. He encourages us to look closer at the products and services we use regularly, transforming our mundane experiences into insightful investment decisions. Bill Ackman, a well-known activist investor, urges us to be business analysts, not just stock analysts. He is widely recognized for his astute investment strategies and his keen ability to reshape organizations from the ground up. His core philosophy revolves around the importance of grasping a business's fundamental aspects. He believes that merely analyzing stocks is a narrow approach. Instead, he insists on delving deeper into the roots of the business, understanding its operations, comprehending its financial structure, and analyzing its market position. This comprehensive understanding, according to Ackman, often reveals hidden opportunities for growth and value creation. He emphasizes this approach as it can help in identifying potential areas of improvement and in mitigating the risks associated with investments. Ackman's tactic primarily revolves around carrying out a systematic evaluation of a company's performance and its competitive landscape. He also stresses the importance of analyzing a company's financial health and its leadership team. He maintains that studying the dynamics that drive a business's success or failure can be the game changer, leading to successful activism in the investment world. By implementing such a strategy, we can instigate significant changes that potentially unlock shareholder value, paving the way for increased returns on investments. Understanding the fundamentals of a business is key to successful activism and can lead to significant changes that unlock shareholder value. Then there's Jim Simons, a pioneer in quantitative investing. He believes in making data-driven decisions and stresses the importance of proving your theories with solid evidence. In his world, it's not just about what you know, but what you can prove. Lastly, we have Michael Burry, who shot to fame for his contrarian bet against the US housing market. He advises to follow the scuttlebutt, meaning dig deep, do your research, and don't be afraid to go against the crowd. In conclusion, successful investing is a journey that requires continuous learning, adaptability, and a deep understanding of the market. Apply the insights from these financial visionaries to your investment strategy, and you'll be on your way to prosperity. Stay tuned for more insightful videos on investing. Happy investing.